Thank you very much, and what a delight to be here this afternoon. And thanks to NAREDCO to have put up this fantastic program. And I know the amount of hard work that has gone in. Certainly I know I haven't seen Sandeep Runwal working that hard in his own business the way that he works hard here at NAREDCO. So big round of applause to the team at NAREDCO. They've done a fantastic job. And a fantastic job to have this panel. I mean, this is like the money bags, that are sitting in here. Anybody would want to.
If I may add, the other time Sandeep Runwal works harder is when he negotiates rates with banks.
So, it is a delight to be able to get in, all the powerful guys in the industry on this platform. I'm very excited. I've got about 45, 50 minutes. I'm going to, monopolize that entire time. I have a list of like 50, 60 questions that I need to ask. I'm not sure I'll be able to cover all of them. But Rajiv, let me start with you. First, I've known you, perhaps the longest in this. It's a little bit of a delicate question, if I can ask that, is, on one side, our Prime Minister is saying housing for all, and everybody's pushing it, and we are having that housing for all happening. And on the other side, whilst the real estate is doing well, it does appear like the affordable housing, which really contributes housing for all, as a percentage of the overall sales is going down. My question to you is that what can we do to accelerate, this affordable housing? And I do feel is somewhere in that financing has a role to play, whether it is on the retail side or on the wholesale side.
Actually, if you look at probably the intent of what the government wants to do, or always has wanted to do, is to probably look at a lower end of the affordable housing. Today we have also upped the value of what we can call as affordable housing, because
That's true.
it sounds good.
Yes.
To tell the investors that we do a lot of affordable housing. So the more you up the definition on value, the better it looks. But I think, if you go to markets beyond Mumbai or Delhi or the, center of Bangalore and other places, we clearly are seeing affordable housing happening, based on what the definition is. If we call affordable housing as something below 50 lakhs of homes, there is supply. You go to tier 2 towns, tier 3 towns, that is exactly what is happening. Nothing beyond that is happening there. So I don't think so. That is, to say that affordable housing is not happening is not right. Actually, we see a lot of business happening there. But what has happened is the premium housing percentage has shot up so much.
Right. Yes.
That as a percentage of the total, it looks lesser. But I'm really not talking about so much on houses which cost 35 to 50 lakhs. I'm talking about houses which cost less than 25 lakhs. That, if you look at the population and you go in deeper markets, that is what, is required. A lot of people even can't afford 50 lakhs of housing. And there we see there is a huge dearth of supply coming in. Today, I don't feel so it's a financing issue, because I'm telling you, we've put together a separate unit which just finances houses which are less than 10, 15 lakhs. So, and we want to do more of it. So I don't think so there is dearth of finance, and we're seeing this with so many other players in the market. But still, we need more of it. And I think it's been referred so many times that how do we create better incentives, or how do we bring down the cost of housing? That's been a challenge which has always remained. while we have a lot of PLI schemes supporting manufacturing, I wonder, whether we should create something of that nature for housing, which supports housing, which probably is more basic in need. And I can't even say it doesn't create more jobs. It creates more jobs also. I believe on an overall basis, I don't think so affordable housing as we call it today has gone down. It's just that the premium segment has grown more. But if I look at housing of value less than 25 lakhs, I don't think so it's growing at the pace at which we would like it to grow. And probably it needs support from the state to make that happen.
At a global level, Rajiv, we are seeing is that there is nervousness from the bankers and the financiers on the commercial. Are you seeing that reflection in India?
See, I think we all are seeing this over the last maybe 6 to 9 months or 12 months. There is a slowdown in terms of absorption which has happened. This is something which we used to speak about when COVID was there. We all spoke about the fact that hybrid way of working will sustain over a longer period of time. And today, every organization is okay with it. And we are all realizing that even if you are in office for 3 days, it's fine. No work does not get hampered. It's not that the culture doesn't get built, and so on and so forth. So what is happening there was visible. At least we could see it, that that's going to be the trend in the future. We saw a fair amount of absorption happening just as COVID was ending. And that, largely also happened because of the fact that people thought that they could move to better offices, or the fact that a lot of work moved from US and Europe to India. I think with the recession hitting some of those markets, there will be some slowdown happening there. My personal view is that will we see growth in that market? We will see growth. But we will not see the growth which we saw 2 years back. I think we all need to live with the situation that hybrid way of working will exist, and people will find ways and means to manage cost of working.
And as financiers, you're okay to fund office and retail. There's no hesitation in your mind.
Retail is doing extremely well today. If there is one segment you are more sure of today than even residential is retail, it looks like. It's doing extremely well. So I don't think so there is a problem. But commercial, personally, one has to be a little more circumspect than the other two sectors, I would say. You would look at who's the person behind it, the ability of him to hold it for a longer period of time. And especially when we saw good commercial activity, a lot of speculative commercials started getting built. Something which I think you also have advocated not to do it at the same pace. But I think so good times we all forget. So if we forget, then we will need to pay the price somewhere.
Right. Yeah. Atul, you're amongst the most aggressive, guys, and it is interesting and aggressive on both the terms. One in terms of the technological advancements, that you've brought in onto the financing side, and second is, understanding, adapting, and then financing on the real estate. My first question is that on the real estate side, we've gone through a lot of structural changes. Do you think we're sort of almost towards the end of that? As a financier, what would your opinion be in terms of the structural reforms and the consolidation that we've seen in the real estate sector?
See, my personal view would be consolidation in real estate is here to stay, because what we have seen in specifically top 8 markets, because what we refer as a real estate, I think largely we come to the organized development and the developing units, which is basically top 8 or top 10 cities there. The consolidation is here to stay. But real estate is also a sector, Anuj, which will always have strong micro market player. It will never become a fully integrated one corporate doing all micro markets, because the micro market play, the micro market understanding, or the micro market nuances of the local factors and the brand name availability there for building as per what that micro market requires will be there. So trend towards consolidation will be there, but it is not to say that only 10 players or 20 players or 30 players will survive in each of the market. We believe there will be 10, 20 large players in each market, and there will be a plethora of strong players who are dominating those micro markets. That's our take as of now.
Second is, Atul, you guys have brought in a lot of technology, within your business. Are you seeing significant advantages of this, the technology adaptations that you have brought into the business?
Yes, on the retail side, if whatever my team tells us is correct, then I think probably we are the fastest turnarounds because we turn around in matter of hours and minutes, not in terms of a home loan availability, in terms of CRE or developer finance. I think we turn around in number of days, not weeks or a vice versa, days and the weeks, what generally tell. A lot of it is getting enabled through technology. Lot of the work, what people used to do for underwriting. See, when you underwrite a case, specifically in a retail, in a wholesale, there is a different in underwriting. There are so many things which you can today make as a system driven, and the system can throw you a result quite accurately with probably a lower degree of error than what a human eye will do. So yes, we believe, yes, technological advancement to service, ability to service customer better.
Your outlook on the interest rates?
It's the most difficult question to answer probably today. Reason is because, but I personally believe probably we have hit the peak of the cycle, barring until unless there is anything large geopolitical event happens in the world at large. ECB probably has did their last raise yesterday to 4%. It is not expected they will raise further. Fed also is likely to pause. So if inflation rates don't go up in the advanced world anymore, probably we reached the end of the rate cycle. However, there is a big delta or a big if factor in when we say interest rates have peaked in India. In history of this country or in history of the world, it has the minimum differential between a US Fed rate and India rate had always been minimum 3% to 3.5%.
Yes.
That is essential for our currency support and our currency being remaining at the level where it is. And we are, since in any case, a forex deficit country from the trade balance, from the current account balance. Today it is hardly at 1.5%, 1% to 1.25%. I don't know whether the currency will be able to sustain because the currency is sustaining on account of very high FFI flows and FDI flows. If FFI flows and FDI flows continues, we will sustain the interest rate. If there is a dip in the FFI flow and FDI flow, coming election can be a delta there because in light of a coming election, there can be probably a temporary halt or stoppage of those flow. We may see a uptick in the interest rate. That and probably a geopolitical situation which is cannot be predicted. If a nuclear war happens in Europe, maybe a limited or the Ukraine conflict gets widened, then it is up for.
Despite substantial liquidity in the market, there are a number of developers, there are a number of people in the room who are going to say, Atul, is that we don't get funding from you. Despite, substantial liquidity in the market. Not you, I'm just saying is, from the lenders. What is it that they need to bear in mind when coming to you for asking money?
Yeah, because for us, I think you contradicted the first statement you made on most aggressive players. So then saying not available from our side, I think that contradicts. We see, everyone is there to do business. The only one factor I'll say, not from, it's a general statement, not from point of view. See, when we fund a project, any financier funds a project, any bank or any NBFCs funds a project, the margin of the financier remains the same, whether it's a boom time or the bust time. In fact, in the boom time, it goes down. And the margin what you earn is in a low digits, which is maybe in a housing loan, even less than 0.25%, in a construction loan, maybe a 1.5%, 2%. That is not sufficient for you to take some risk which entrepreneur will take. Because for an entrepreneur, the probability of getting a much higher return is much high if the call clicks. So if there is a call which as an entrepreneur on the other side will be willing to take, maybe a financier is not willing to take that call because the return for the financier is not linked to the success of the project. But the returns or financial money not coming back is definitely linked to success of the project. So I think that's the basic difference between the way a financier looks at the things and the way a project builder will look at the things.
Rakesh ji, in our industry, tier 2, tier 3 markets are doing pretty well on the real estate. We are seeing across whether it's residential, whether it's retail, whether it's warehousing, industrial. Tier 2, tier 3 cities are doing a fairly good job. I just want to understand on the financing side, is it as vibrant for you as well?
So completely, if you see, and especially post-COVID, now work from anywhere, people, and especially on the IT side, people have gone to their native places and they can operate from anywhere, work from home. So that has really provided opportunity. Earlier, it was more metro-dominated, so Mumbai, Pune, Bangalore, Delhi, Chennai. Now you have Kochi, you have Coimbatore, you have Lucknow, you have Indore. I think a lot of businesses are being, and also remember where real estate will do, where the job creation is there. So everything is linked to the job creation and the livelihood. And if the business environment is good in that tier 3, tier 4, you will have the business and the economic activity, and that will drive the real estate. And clearly, we see that, especially in tier 3, 4 markets, in tier 2 markets, both on the residential side and also now on the commercial side, because a lot of mid-sized corporates, they have or the back offices of global companies are there in these centers, and they employ a large workforce. So clearly, that drives the real estate activity, the housing, and all of that. And in a way, if you see the rental yields in a tier 2, 3 will be better than a Mumbai and also. I think that really drives, and wherever the economic activity really grows, and we have seen that now in India as the emerging income middle class is coming up. I think India is not about the top 10, 12 cities. India is about 100 cities, 200 cities, and that's how things will drive going forward. So today we clearly see a lot of emergence of lot of tier 2, 3 cities, which is coming both from a commercial point of view and that will drive residential. So clearly, Anuj, that's the trend which we see.
And then Rakesh, from your perspective, you're happy to fund tier 2, tier 3. There's no fixed criteria to say that you're not going to entertain some of these smaller cities.
No, completely. So we are quite open. In fact, our strategy is that we want to go deep into tier 2, 3, and 4 cities in India. And if you look at on the retail side, and for a minute, if you look at the growth which has come over the last 2, 3 years on the retail side, on the consumer side, tier 2 and 3 cities are growing faster than the tier 1. Yes, the absolute value is still lower, because the size and all scale is very, very different between a tier 1 and a tier 2 cities. But there is a huge opportunity, and that's how we look at it. So our products, our processes, our entire business model is based that what we can do in tier 1, I think if we have to go to a specific market, I think we need to make those changes. So we are very, very open. We are very keen in terms of doing business in tier 2, 3 markets.
In the last few years, Rakesh, we've seen newer asset classes from the investment perspective come in. One of them is the office REITs. Earlier this year, we saw Nexus, Blackstone do the retail REIT. From a developer's perspective, are these instruments worth considering when you get into the fundraising perspective?
I'm sure these are, because I think this provides one more opportunity from a fundraising in terms of generating cash flows. And SEBI has brought down the limits now, so the retail investors also can come in. Now the limit has come down to 10,000 rupees in terms of, so it's another asset class. So we have seen proliferation of investment into stock market, or for that matter, into mutual funds. But real estate brings another asset class where the retail investors can really invest. And you're investing, you're getting a return, and you're investing in an appreciating asset in a way. So diversification of asset class, getting a consistent in terms of the returns. And from a developer's point of view, really building large commercial, if you are building large commercial infrastructure and you are putting it up on rent, I think you can really generate cash flows on that front and raise liquidity to really raise it and invest in the next one. So clearly, this is a very, very good, I think, move. And especially with now retail investors, it's being made accessible to the retail investors. I think we need to create more awareness and we have to create more in terms of distribution so that the retail investors can come in the large scale in REIT as well. So I think that's a good move.
And Rakeshji, there appears to be a dichotomy, the tier one developers, who necessarily don't need money because, they're able to, at the time of launch on the residential sell, they're getting a lot of money come in from big boys, who are on this panel and others. Yet the smaller developer, tier two developer, is saying is that nobody's funding me. So, on one side, you have larger developers who actually don't need money, but are getting, offers to, pick up money. And on the other hand, there are smaller, perhaps tier two developers saying is, look, we're not getting any attention at all.
So if you see larger developers are getting into tier two, tier three markets also. So in a way, the way Atul mentioned, it's about consolidation of the market as well in real estate. And every market, and especially in the real estate, the nuances are different. The micro market much better, your networking, your ability to acquire land. So I think it's very, very different skill sets. And that's the reason if you see a lot of developers who really specializes in these markets. So it, again, boils down to the risk appetite of an institution in terms of what is the kind of risk appetite you have in terms of going to tier two, tier three. We are quite open to do business in tier two, tier three, whether lending to the developers. But again, they're also developers which has a established track record and has the ability that they have been able to deliver a good quality product in the right time, and where the customer at the end of the day is the customer who really are there to accept and absorb that product. So we have to look at the entire lending is a lot about in terms of establishing the profile, the cash flows, everything. So, but we are quite open and we do business in these cities.
Yeah. Paritosh, couple of questions quickly. One is that you also look after the funding in the non-real estate sector.
Yeah.
How do you compare that with the funding on the real estate sector?
I think over last, say, since RERA and other regulatory changes have come, real estate has also become like a regular industry. So we see it more like a regular industry nowadays compared to...
this is real music to us. For 20 years, we've been
10 years
beaten.
ago, it used to be when there was no regulation, one was not so sure about, but now there is far more discipline. So it is becoming, even for bankers, when we see it, it is more like a regular industry. And I can tell you, for us, as part of the wholesale bank, real estate is one of the largest sector where we have an exposure. So from a sector perspective, this is one of our largest exposure. And so see, other industries, say manufacturing, service industries, etc., small scale borrowers, we have a very high degree of clarity on their cash flows. Their cash moves through our system, they use our transaction banking. So we draw comfort not just on the security, but on their larger businesses. And what kind of customers they have, what kind of vendors they have, how the money is moving. So if we can have similar comfort on real estate developers, which is post-RERA is coming in, it is giving us much more comfort. So I would say we treat them more similar to any other industry. But because of the lot of other risks involved, including price risk, including regulatory risk, etc., the security requirements are a little different compared to, and also RBI asks for different capital charges, and hence the pricing becomes a little different compared to other industries.
Paritosh, in terms of the conservativeness that we have seen, from regulators and the Reserve Bank of India on funding for the real estate sector, particularly when it comes to the land, we had seen that there was a gap, and the NBFCs, filled that gap on the land funding, and now Reserve Bank of India has come back and saying is that you're not allowed even as an NBFC to fund the land. So how do the developers really go about doing this?
See,
I mean, is it only equity now that that they can raise money for the land, or are there other ways?
I think the real estate industry is evolving into landowners and developers separate. So there are a set of people who own land. There are a set of people who are very good in execution, in sales, and managing the approvals, etc. So if you see people who are building businesses around owning and maturing land, they make multiple returns. They should have no problem in leveraging, even if they have to go to credit funds and borrow money through AIFs, etc. But when you look at developer who is either taking a land and immediately converting, they should be able to get, if the land is being used for residential, nowadays with the kind of buoyancy you see in the market, you hardly need really construction finance. Your initial money itself takes care of most of your funding requirements. So if you really see, unless you are wanting to speculate on land, you don't really need so much of land funding. To some extent, larger developers are able to leverage their existing projects and use that money for land. There, the issue is end use, where I guess a lot of NBFCs, couple of us are sitting here and who are very happy to fund those situations.
Paritosh, are you seeing an increasing trend of Indians investing into global real estate?
See, I think with the income levels rising, there is certainly a demand for second home. And we have seen places such as Goa, for instance, is one of the most prominent locations where post-COVID, the amount of investments have happened into residential properties in Goa is very, very high and never heard of. I don't really see too many investments globally from Indian investors. So under the LRS schemes, etc., people are more investing in financial assets and not so much in hard assets.
A little bit of you want to
I just want to say, as bankers or lenders, you will know this if they need financing. Most of this investment is happening through own funds. So that is why, are Indians buying a lot of properties out there? They are buying, but are they financing those properties? No.
No, understood.
So that is why probably bankers and lenders don't get to see it. We only hear about it.
Good point, yes. Paritosh, do you feel that, like many other industries, even in real estate, the developers should complete the project and then start to sell? I mean, when you go out and buy a shirt or a suit or a car, it is all sort of made and then sold.
See, buying a shirt and buying a flat or is not really comparable, because your investment requirements are so large. If you, I don't think that is how developers should do it, and neither flat buyers or consumers are expecting, because if you move towards that situation, then the capital requirement for developers will keep increasing, and that also keeps them open to the risk of if the property prices change, then the entire risk will be taken by developer. As far as consumers are concerned, they're happy if they are comfortable with the brand who's developing, and with the current regulatory changes, people are more than happy to buy under construction properties. So I don't think...
You don't think that the trend will move in that is? Rajiv?
I'm just saying, does that option exist? If that option doesn't exist, that option would have existed if the answer to your previous question was yes, that land funding is possible. If a developer is going to put his own money in land, and then you expect him to put money in construction also and then sell, it becomes very difficult.
Yeah, unviable only.
So today, why some of the projects become more viable is the developer doesn't need funding for the whole construction. He probably needs for 1/3 of the construction cost because 2/3 are met by customer advances. So the cost of the project will shoot up if he either takes debt, and I'm sure customer equity will be more difficult because if he's already put money in the land. So you have to solve for the first before you jump to the second option. That's what I believe.
Also, we are in a world of increasing and improving efficiencies and economics by constructing out of borrowed money and even equity. If you keep investing equity, you need equity return. So the cost will keep increasing for the property. I think we need to have finer, the turnaround time should be faster. The utilization of working capital should be as shorter for a period as possible, which is only when you use customer advances, sell as early as possible.
I understand. I understand.
And when you have interest-free money, why will you pay interest?
My final question before we open it up is to all the four panelists, and I'm going to start with you, Rakesh ji. Is we're seeing more and more developers getting onto the listing space, and everybody's had their views whether it is good for a real estate company to get listed on the stock market or not. I just want to understand from the four of you what your thoughts are. Are you for? Or you think is that, no, it's not a good idea for a real estate development company to get listed?
No, so again, it depends on what you're looking for. If you're looking at raising funding, and I'm sure it is advantages that you should go public and raise funding. So clearly that provides that opportunity. Irrespective of whether it's a real estate company or any other corporate which gets listed, there are its own challenges in terms of bringing in transparency, compliance, and all of that we need to do. And on the top of it, it's quarter to quarter, you'll have to complete delivering it so that...
Yes.
So it depends on what the end objective of the company is. But yes, it's a good way of raising public money in terms of reaching out to the larger market and asking for the money. And we heard how difficult it is to get funding for land and then constructing it and all of that. So I think this is a...
You're for getting into...
Yeah, and this brings in governance, compliance, all of that.
Atul?
I would definitely say that I think the trend towards listing is a very positive one because it will bring more... After RERA and other regulatory changes, the sector is much more organized and much more moving towards a compliant and path in last few years. Listing would be the final step because when you are getting outside investors, one, it is difficult to sell to an investor to part with their money to share with you. So they become your partners. It is both cheapest and the most expensive source of money because you can technically say it is a no interest to be paid on there, but the trust what the person is putting in is much more. It will definitely bring in much more compliance and it will definitely bring much more transparency and a much more long-term source of funds for the sector. And more corporatization or the listing, I think better it is for the sector.
So Rajiv, both Atul and Rakesh are for.
No, according to me, it just depends on the business strategy of the developer and the size of the entity. Today, we meet some entities where the market cap is 250 crores. So you sometimes wonder, why did you ever... so I'm saying, your business strategy should determine, but if your size is large and you wish to grow, because there are a lot of developers who are happy doing 5 projects at a time, that's it. And that's the way they want to run the business. Nothing wrong with it. So it really depends on the business, strategy as well as the growth. But if you are of the size and you wish to grow, then listing is a very good option for you to take. Obviously, nothing is free. You have to give return on shareholders' money. If you don't, then the next time you don't get money cheap. So, I don't think so anything is free.
Paritosh?
I think I agree with Rajiv, it's a question of size. If your size is too small, it doesn't make sense because the cost of compliances and all of them are too high. Also, unless the total market cap of the company is substantial, you will not get quality investors. So if you do not get quality investors, it doesn't give you a stable outlook for companies which are also another thing is stock market expects a certain performance quarter on quarter, and this industry is not necessarily where you can keep selling so many shirts or so many soaps or so many cars every quarter. So there will be ups and downs, and that's when market really punishes the stock. So unless the size is so large and you have multifaceted businesses,
Paritosh, is it easy to define the size? I mean, just for the audience to know what
I would say
ballpark.
if the market cap is more than $500 million, then probably you will get better
4,000
quality
crores.
investors.
4,000 crores as the market cap.
You will get better quality investors
Mr. Runwal, you heard that?
He was thinking about 5 billion. You want to
He's
stop him
thinking
at
400 million
million?
is okay. You know, that's okay. No worries. Guys, you know, we are going to open. We have about 9 minutes left, you know, for this session to end. You know, feel free to ask any questions. You know, this is like the most eminent panelists that you're going to get on the financing. If any one of you have got any question to ask, you know, please raise your hand. You know, hopefully we'll get some a mic across to you.
And one question I also wanted to ask, Anuj, you know, you always ask the panelists what happens to tier 2 and tier 3 developers. I genuinely want to know that, you know, what is the real credit demand from developers for tier 2 and tier 3? If it is not being met today, how is it being met? And really, will the presence of organized players really help? I don't know because...
I think it's a very good question that Rajiv is asking. So I don't know, Sandeep, are there in many tier 2, tier 3 city developers in this room? Or if there is anyone who's from a tier 2, tier 3 city or has operations in a tier 2, tier 3 city, I think the question that Rajiv is asking is, are you finding any hesitation in funding in those cities, or you think is that those are well catered to? And if you are finding it difficult, then if a big player was to come in or a more organized lender was to come in, would that help? I think that's the question that you are trying to...
I think we have members from Nagpur, Akola here.
Yeah, we have a few guys at the back.
Puri येऊन जा ना. So maybe he can answer this better. And he's also the president for NAREDCO Vidarbha.
Acha, very nice. Very nice. Please go ahead. We'll be able to hear you. Go ahead. Here, you can take this mic. Sir, there's a mic up here.
Hello. Yes, sir. Myself, Ghanshyam Dokne. I came from Nagpur, which is, you can say, tier 2 or tier 3. You may define in whatever slots you can. But as rightly said by Rajiv sir, I do agree. There is a substantial demand from the tier 2 and tier 3 developers, but they are not aware of the avenues which are available in front of them. And the major reason is there is no school or thought process which comes to them, because financing for them is, hey, tu help karega kya? Tu pass de, tu pass de, tu pass de. This is what the psychology is. And the right system, right process, protocols, documentations, so that has not been percolated to the tier 2 and tier 3 city. For that, I think there is no, what you can say, a systematic implementation process which has to be happened through whichever agency. We are trying our level best through the help of NAREDCO Finance Committee, which we are taking up to Nagpur, Chandrapur, Gadchiroli and suburban area. And we will be educating developers and making them understand there are these kind of avenues are available. And if you go with your systematic documentation, you can take the help of leading financial institutions like you.
No, I think I can add that at Kotak, we are specifically developing products for financing in tier 2 markets for real estate. So Nagpur, Lucknow, Agra, Jaipur, Chandigarh, all these cities are priority for us. We think over next 3 to 4 years, our business in the top cities will be equal to what business we have in the tier 2 cities.
Wow.
That's how it is also our strategy to go granular, so that we have less concentration on one borrower and we could have more granular presence.
Sir, one more point I would like to add. See, knowing their
So we've got less than 5 minutes.
knowing their unknownness, the private players, that is the private players I'm saying, they are usually influencing the financial market over there. So there is no systematic financial.
I know we understand that. And that Paritosh has addressed it, Rajiv.
So
You may want to
I'm
add.
just saying for, in short, that all the markets, like Chandigarh or Jaipur or Nagpur, Nasik, we are already covering. So we don't call them tier 2. I think in these markets, we are already lending. I was talking about the next set of markets which exist today. But I'm saying, since we talk about this at NAREDCO, if somebody at NAREDCO can put together a paper of these are the next 10 markets beyond these, because these are all known. I don't think so. Jaipur, Chandigarh, we all know and we are all funding there. But the next 10 markets, which are those which have organized developers? Because we also won't want to go to a place where there are only couple and the rest of them is self-construction. Because self-construction requires a different set of funding, or only floors are getting constructed, which requires a different set of funding rather than, organized developers. Which are the next 10 cities? We'll be happy to look at which are the next 10 cities. And maybe in the next couple of years, try to see if we can be there and lend to those people.
We can take one more question. Sandeep, go ahead.
So, since I have all the 4 leading financial heads here, the question is land funding not available, premium funding not available, FSI funding not available. We are reading in the papers, organized are getting bigger, better. People who don't want money are getting more money. People who want money are not getting money. Then there is this conflict of raising IPO capital or not to raise because it's very expensive. And somehow real estate is not being treated as an industry. So every capital, how long do we keep borrowing at 18%, 20% to fund land, to fund premium and FSI? And does the debt we take eventually become a death trap for a lot of us? How do you resolve this? Because this is a question which is going on for, I think, a couple of years or maybe more than 5 years. And I do not see even any intervention from the bodies being taken up with RBI. Because if you see the default in the industry, it's one of the smallest compared to manufacturing. And most of you still recover at least your capital. It's not that you're writing off 80% of your capital in some sectors we have seen. So do you think there is a solution if you want to think about it? And if you can share with us, it'll really help.
So Sandeep, I don't agree with you. We fund land, we fund FSI, we fund premium. So I think the question is, if someone is purchasing land and wants to sit on it and speculate on land, then bank funding may not be possible. But if you have a plan to purchase land and build a project, then there are NBFCs who are more than happy to provide. So key is how soon you can get an approval and convert land into a project. That is when we treat this like an industry, which is purchase land, execute, get approval, execute and sell. So the sooner the market moves to a faster execution, the funding is available. Even otherwise, as Kotak, we have multiple, arms of the group where we do provide all kind of financing. Some are expensive, some are not so expensive, but funding is available, is what I would say.
I would agree, Sandeep. Funding is available for everything. I don't think so that is the issue. The challenge at times comes when somebody has owned the land, which was bought at 20 crores. Today, the worth may be 100 crores and wants 70 crores against it. Or he's buying land and he's saying, why don't you finance 80% of it? That won't happen. So I think financing is there. On your other question of debt, lenders will always fund more where the risk is less. That is all given. That you will also do with your own money. So I think debt trap is a real issue, and everybody should contemplate after seeing what has happened in the last few years. And it's all a function of how much debt compared to the number of projects which you are doing. I always say, if you are doing 10 projects, please, for God's sake, ensure that 3 projects are absolutely free. They have no debt on it. Or you have some commercial property, it's not fully leveraged, so that in case you need it, whether it's retail or whether it's commercial, in India, nobody can predict when problems will occur. I cannot predict, you cannot predict. So we all have to keep money. Like we keep our personal money, some extra money available for eventuality. Same way we have to keep it for business. But I've seen this discipline become far better over the last couple of years, but I still see it in certain places where virtually you find all their projects have leverage on it.
Anuj, if I can just add one small point. I think over the last 2 years, Sandeep, what we have seen that leverage levels with most of the developers have come down. People have liquidated their inventory and saw in the residential volumes have gone up. So the debt levels for most of the developers have come down. I think the overall, we don't really see any concerns lurking in this segment currently.
I think another way to look at it, Sandeep, would be, see, in any project, because in normal industry also you are setting up, there's a debt equity ratio, right? So you have a 1 equity and normal 1:2 is the debt equity, even if you're funding any industrial project. Same way in any construction project or any residential project, the way a lender will look at it, there are 3 sources of money. And all 3 need to have an equal weightage. One is a developer equity, whether by way of a land or the investment. A customer equity, which is because of an advance sales coming in. Third is a debt. The problem normally comes in availability if one of the leg is missing. Any table which has to stand on 3 legs, if one leg is missing, it is going to become imbalanced. So all 3 are required. I think if there is a balance in the project of all 3, probably I'll agree with Rajiv or Paritosh, availability of funding is not a problem.
Just one point I want to say at the call. See, it is not true, and I'm being very honest, because if I'm not honest, then it's not true that people have not lost money in real estate. You know enough examples, we know, and probably Anuj knows many more examples than all of us know. People have lost money. We know that the biggest lenders had delinquencies which were 3 or 4 times in corporate lending or real estate lending compared to retail lending. It's a fact. Some companies have not faced it, doesn't mean the industry. There are NBFCs who have actually shut down because of this. So, it's not true that there are no losses. And in banking or financial services, it's not about losses. It's about NPAs, which, if NPAs shoot up, nobody will lend to you. Even if you can recover the money 5 years later, you are gone.
And completely, I think it's about where the debt trap, and we have seen as when a lot of people move from core business to non-core. A lot of people in so many businesses, and they move to a real estate business and try and invest in real estate. I think if there is a project, there is a cash flow, I don't think a debt trap, and we heard from all of them. So just sticking to the core business, I think that itself is important point.
I think this debate can go on for a very long time, but no, I appreciate, what the panelists here have said is, clearly, Sandeep, one may think is that there is, very little delinquencies. I think Rajiv articulated it very well. Ultimately, it's not about the loss may be less, but it is also about the process, and in the process, the NPA really hurts the lender, because the inability to then go out and raise further monies, becomes a big challenge. Just final word from Sanjay, and then I'll close this off.
Thank you, Anuj. All the answers, I agree. I think the question was cost. And the question was, NBFC funding is available, but it's very expensive. And some of the NBFC pain, which we have observed, and we saw it during NBFC crisis, was also because NBFC wanted to charge higher processing fee, higher targets, higher LTVs. So NBFC has equal role to play in bringing these developers down as much as the developers themselves. And I can vouch that because I've seen that happen. So just to say developers only did it, I don't agree with that.
Nobody's saying it could be either ways. I think one thing which can help the industry genuinely is that problems can occur anywhere. But if a problem occurs, can the industry come together and work with the financer to solve it within 90 to 180 days? Because ultimately, when you solve it, finally, how does it get paid? Because the resolution happens 3 years later or 4 years later. Can industry work with the lending industry to solve it in 180 days? The confidence level will shoot up.
Big thing. Thank you very much. Thank you very much to the panelists. I know that this could have gone on for another 1 hour. Thank you, Rakesh, Atul, Rajiv, Paritosh. Fantastic, opportunity to hear your views and hear that this industry is finally maturing, consolidating, and is becoming like any other more mature industry. So thank you very much for that endorsement.